Good evening, students. Welcome to the session. So I hope you would have revised till now the cost plus method, what I had asked you to, the cup method, what I had asked you to revise in the last class, because that's what we had discussed in the earlier class, right? And if you have any questions concerning that, you can ask me. Otherwise, we'll proceed for the next method, which is the resale price method, right? So we have already discussed the first method, which is the cup method. In the cup method, what we are comparing is the direct comparison we are making with the price of the commodity or the price of a service, right? With that of the controlled price. So a controlled price we are comparing with an uncontrolled price. And as I told you, there can be an internal cup, there can be an external cup, right? Now moving towards the next method, which is resale price method. The second method we are going to talk about now is the resale price method. Now in the resale price method, as the name tells you, it is basically going to look into the resale price margin. Now this is not based on the price comparison. This method is based on the comparison of the gross margin. This method is based on the comparison of the gross margin. This is not a price-based method. This method is not based on the pricing. This method is based on the GP margin, the gross profit margin on the sales. Similarly, the cost plus method, the third method which we are going to talk about in a while after this resale price method, that method will be focusing more on the GP margin on the cost. So these are the different methods we are going to talk about, right? So the first method which we have discussed till now, if you see this one, just give me a moment. There's some issue, I think. Just give me a moment. So, in the first method which we have talked was the cup method. That method was more so based on the price comparison. But the CPM, RPM, and your TNMM, these are based on the comparison of the margins. In that, your CPM method compares the GP to the cost. RPM compares GP to the sales. And TNMM compares the net profit to the cost or sales or assets. So there are different indicators because TNMM is the residuary method. Are we clear? So let's talk about the resale price method. Let's take a small example. Say for example, AB Limited has purchased cars from its parent AB Inc. US, right? And then it sells those cars in India. So AB Limited has purchased the cars from AB Inc. and sells those cars to the customers in India, right? It has purchased the cars at rupees 12 lakhs. It has resell the car at rupees 13.5 lakh. It also incurred, say, certain expenses amounting to rupees 1.2 lakh on import. Right? So it is purchasing cars at rupees 12 lakh, selling the cars at rupees 13.5 lakh, and it is having certain expenditure of 1.2 lakh on the import. So this is briefly what AB Limited does. Now, if you notice here, which of the transaction is a tainted transaction? Mind this word tainted. What do we mean by the term tainted? Tainted means the controlled transaction or the transaction which is getting affected because of the relationship of the associated enterprises. So which of the transaction do you feel is a tainted transaction? Let me hear from you. Quickly in chat boxes. Whether the purchase transaction or the sale transaction, what I should be comparing? What I should be exactly comparing? Naveen, yes, correct. Yes, Yogesh, right. So which transaction? Which is a tainted transaction here? Very quickly, not a difficult question at all. This one is the tainted transaction. Purchase. Isn't it? I am purchasing the goods from the associated enterprise. I am purchasing the goods from the associated enterprise. So obviously this transaction would be the one which is a controlled transaction, which is nothing but a tainted transaction, right? So therefore, what I should ideally be comparing is the purchase. Sales is to the unrelated party, right? It is the purchase price, which is a tainted transaction for which I should be finding a comparable. So two options here. I can use very well a cup method also. I can find out the price at which some unrelated party, if I would have purchased from the unrelated party, what would have been the price instead of 12 lakhs? Or a similar transaction taken up by the external parties, what would have been the price? So we could take up a cup method also in this case. But if you see here AB Limited is acting like a reseller. He's acting as a reseller. He's purchasing the goods and without adding any value, he is making the sale of those goods onward. So therefore, here the most appropriate method should be RPM. Resale price method. Why? Because resale price method is basically for those kind of parties where they are acting as a reseller. It's a very specific method for the resellers, where they are purchasing the goods and without adding any value, they are making the sale of the goods further. So therefore, we will use the RPM method. So RPM is suitable for the distribution or resale of goods. Now, how do we compute the arm's length price using RPM? Let's understand this. So, say for example, there is a comparable transaction. There is XY Limited, an unrelated party, which also imports similar cars. Say for example, this could be say maybe say Ford car. This could be say Toyota. But they are similar, right? So XY Limited also imports similar cars, say at rupees 11.5 lakhs. Say at rupees 11.5 lakhs. Right? This is an unrelated party which also imports the cars at say rupees 11.5 lakhs. And it is selling the car. Sales say at rupees 14 lakhs. Say the sales are at rupees 14 lakhs. Right? So XY Limited, this is an unrelated party basically. Correct? Now, what you'll be doing here is, you will be first determining, in this case, first you will be determining the price, first we will be determining the price at which commodity is resold to an unrelated enterprise. So what we are first doing is, we are determining how much an unrelated party earns the margin. So they are reselling at rupees 14, less they are purchasing it at 11.5 lakhs, and therefore their gross profit is 2.5 lakhs, right? And their GP margin on sales will be 2.5 lakh divided by 14 lakhs, right? Which comes to 18%. So this is the GP margin of unrelated party. This is the GP margin of the unrelated party, right? Now, what I'll be doing is, I will first identify at the price at which the commodity is sold to an unrelated party, because this is not the tainted transaction. As I said, this is not the tainted transaction. This is the one which is tainted. So I will arrive from year to year. I will start from year and will come towards the cost, the purchase cost. So now what I'll be doing is, on this 13.5 lakhs, which is my selling price, less normal gross margin or normal GP margin, which is 18%, right? So 13.5 minus 18%, it comes to 2.43. 2.43 will be my GP percentage. Less I have incurred certain expenses. So yes, less expense 1.2 lakhs, isn't it? And therefore I will get arm's length price of the purchase cost, which comes to 9.87. And I have purchased it, the transfer price is 12 lakhs. So obviously I have purchased at a higher price, and therefore there will be TP addition of 2.13 lakhs. Are you getting? So what I'm doing, I'm finding out what is the normal margin of the comparable company. And I'm applying that normal margin on my sales, because sales is not a tainted transaction. I have to arrive from sales to the cost. I will reduce the normal GP margin, any expenses, and that will give me the ALP cost. So what are the steps here? First is start with the price at which the commodity is resold to the unrelated party. Then from that, reduce the GP margin of comparables. Then reduce expenses, and finally adjustments, if any, to be made so as to make the margins comparable. This will give you the arm's length price as per the resale price method. Are we clear? Noted, Vidula, sorry. Are we clear? How do we compute the resale price method, or how do we apply the resale price method? Clear about it? Let's solve a sum. You will come towards the answer from your module itself. Okay. Let's solve a question from your module. Illustration 2. Earth Private Limited, Kolkata is engaged in trading of electronic goods. It purchased goods from its associated enterprise Sun PT Limited, Singapore, and also from unrelated party Oceanic Limited, UK. For the financial year 21-22, the GP margin was 15% on the sale of goods of Sun PT Limited, whereas it was 20% in case of Oceania Limited. After sales warranty of 6 months was provided by Sun PT, whereas Oceania gave after sales warranty of 1 year. The cost of warranty may be taken as 2% of the sale price. Sun PT's brand value is internationally known, and the benefit of the brand value can be taken as 1% of the sale price. During financial year 21-22, it sold goods of Sun PT for rupees 20 crores and of Oceania for rupees 15 crores. As regards transport cost of the goods purchased, there was no difference between related and unrelated party. Compute the ALP of the transaction between Earth and Sun PT Singapore by applying the resale price method, considering the facts of the case. So quickly tell me the answers. I need answers very quickly. Very simple question. Yes, Santosh, correct. Priya, yes. Puneet, yes. That's correct. Let's try and understand what exactly needs to be done. So you need to start from rupees 20 lakhs, which is your selling price, which is your resale price, right? So let me do it together with you. So your resale price is your rupees 20 lakhs, right? From this 20 lakhs, what we will do is we will reduce the normal gross profit margin. And what is the normal gross profit margin of Oceania? It is said that the gross profit margin of Oceania is 20%. So less normal GP, which is at the rate of 20%. So 20 lakh, 20% brings us to 4 lakh, isn't it? Right? So reduce rupees 4 lakh. Then there are certain adjustments. It says that Sun PT's brand value is internationally known and the benefit of the brand value can be taken as 1% of sale price. So Oceania's brand is not that much well known. So what we will do is we will add the brand value adjustment, which will be 2 lakh, right? 1% of 20 lakhs. And finally, they have said it, one more adjustment is with respect to the warranty cost. So the cost of warranty is said to be 2% of the sale price, but Sun PT provides the warranty of 6 months, whereas Oceania gives the warranty of 1 year. So what you will do, you will make an adjustment so as to provide less warranty cost, 2% into 6 divided by 12 for the 6 months. You will reduce the warranty cost, right? And what is the warranty cost? 6%, 2% of 6 into 6 by 12, which is 1% basically. So out of 20 lakhs, your warranty cost will be there, right? So out of 2 crores, which is your, 20 crores, 20 lakhs will be your warranty cost. So this is 20 crores. Sorry. This is 20 crores. This is also 4 crores. And this is 16 crores. And the brand value adjustment is of 20 lakhs. Right? And plus this is also will be 20 lakhs. So ultimately your arm's length price or arm's length cost will be 16 crores. Is that clear? They have not given at what price they had purchased, so we do not know about it. Clear? Any doubt? Shall we do one more question on the resale price method? Let's do one more question. Now this is a little bit different question, but it has been a part of your past exam question. Nano INC, a German company, holds 45% of equity in Hi-Tech Limited, an Indian company. Hi-Tech Limited is engaged in development of software and maintenance for customers across globe. Its clientele includes Nano INC. During the financial year 21-22, Hi-Tech Limited during the financial year 21-22, Hi-Tech Limited had during the financial year 21-22, Hi-Tech Limited had purchased software from Nano INC worth rupees 10 lakhs. Worth rupees 10 lakhs. It acted as distributor of that software and sold it for rupees 25 lakhs. to customers in India. It had purchased similar software from Microsoft for rupees 15 lakh for rupees 15 lakh and resold it to customers in India for rupees 25 lakh. The softwares resold are without any value addition. Further, Microsoft provides installation and support services worth rupees 2 lakhs, which is or let's write, whereas Nano INC provides it for rupees 50,000. Nano INC provides for rupees 50,000. You are required to calculate the ALP. Tell me the ALP. Quickly tell me what will be ALP in this case. Very quickly. Okay, different answers are coming up. Let's discuss. Okay. First and foremost, what we'll be doing is we will be identifying the gross profit margin of the comparable. So what is the sale price of the comparable? 25 lakhs, right? And the purchase price is 15 lakhs. 25 lakh minus 15 lakh. And what additionally it does is there is also the installation and support services which the Microsoft is providing. But the GP margin is based on my sale and purchase only, right? Which is 40%. My GP margin comes to 40%. Are we on the same page till now? What is the GP margin you have got it? What is the GP margin you have got till now? GP margins. Please quickly tell me what is the GP margin of comparable? Yes, Vidula, right, 40%, right? Everybody is getting 40% GP margin. Okay. Then what you will do exactly after that? You will apply that on, yes, Santosh, correct, 40%. You will apply that on your selling price to the unrelated parties, to the customers, which is 25 lakh, right? So 25 lakh minus 40% comes to rupees 15 lakhs, right? Comes to rupees 15 lakhs, isn't it? Priya, what is 13 lakh 50,000? So in this case, if you see your arm's length price, yes, Geeta, it is 40%, correct. So you will apply that 40% on 25 lakhs, which is your resale price to the customers, and you will get 15 lakhs as your arm's length price. I'm not adjusting for the time being the installation and support charges, because again these are tainted transaction. Here you cannot reduce directly 50,000. Here we cannot directly reduce 50,000, right? Because if you see this 50,000 which is there is again a tainted transaction, because this is with the related party only, right? This is with the related party only. So from 15 lakhs, I directly cannot reduce 50,000. Nor I can say it is 2 lakhs. But what I need to do is, so 15 lakhs will be my arm's length price, right? Again, for the installation charges, if I need to reduce here, I again need to take at the ALP. I need to take it at ALP. And for this installation charges, I will be using the cup method. Right? Because for installation charges, we will not be using the RPM method. We will be using CUP method only because we will compare 50,000 with 2 lakh, isn't it? So any which ways, Nano is providing the support at 50,000, whereas Microsoft is providing at 2 lakh. So I will take 50,000 as the ALP. Why? For the installation charges. Why? Because if I take 2 lakh, my profits will reduce. And what did I say you at the first place? That if the transfer pricing results in reduction of profits or increasing the losses, then transfer pricing will not apply. So 50,000 only will be my ALP. Similarly, even for this purchase cost, it is 15 lakh. My transfer price was at rupees 10 lakhs, which was already lower than the ALP. So therefore, if I apply the transfer pricing, it will reduce the total income because higher purchase price is my ALP. So I will not apply transfer pricing in this case because it is leading to reduction of my total income. Are we getting that? Are we getting that right? Are we clear? So here the transfer pricing will not be applicable. Clear? Yes, Vidula, correct. Here the transfer pricing will not be applicable. Clear? Any doubts? Shall we proceed further to the next method? Yes or no? Quickly in chat box. Okay, let's proceed towards the third method, which is the cost plus method. Now let me take an example again to explain you the cost plus method. See, we are not doing very theoretically. I want you to understand through examples all these methods so that you can apply it in examination. Are we clear? So now what is cost plus method? As the name suggests, this is the margin on the cost. What we had seen now under RPM was, it was the margin on the sales because it was resale price method. Here it is the margin on the cost. Let's try and understand. Say for example, AB Limited is providing support services to its parent company AB Inc. US, say at the rate rupees 25 per hour. So AB Limited is providing these support services to its parent company at rupees 25 per hour. Now, this AB Limited also provides similar services to say XY Limited, which is an unrelated party, right, at rupees 36 per hour. Right? Now, what happens here is, here I am providing the service to XY Limited at 36 per hour. I am providing to AB at 25 per hour. Now, basically, AB Limited is a service provider, right? So, if you look into the AB Limited P&L, there will be the sale of services to AB Inc. at say rupees 25 per hour. say number of hours could be 10,000, right? And it will incur certain cost, say employee cost, office cost, whatever cost it will incur for providing these services. Now in this case, if you understand, here the tainted transaction is this one, is the sales, right? The tainted transaction is my sale, isn't it? Because I am providing the services to my related party. So that is my tainted transaction, right? So what I need to now find out is what should be the arm's length sale price. In the RPM, what we were doing? In the RPM, we were purchasing from the related party. So in RPM, the entity is purchasing from the associated enterprise. So therefore, we need to find out the purchase cost, which is the ALP. It is selling to unrelated. Here under CPM, I am selling to the A. I'm selling to the A. So this is what I need to find out, my sale price as the ALP. And therefore, in the CPM, we arrive from cost to the sales. And here we arrive from sales to the cost. And therefore, here we use GP upon sales as the indicator. Here we will use GP upon cost. Always remember, this particular denominator should be untainted, because this is what you are using for finding out the ALP. Are we clear till now? Very clear? So therefore, in CPM, we will start from the cost. We will find out the margin on the cost, and then we will find out the selling price to the A, right? So now understand this thing. Say for example, this ABINC, let's say ABINC makes immediate payment, while XY Limited takes credit period of 45 days. And say the AB Limited's direct and indirect cost is 15 per hour. Is 15 per hour, right? So AB Limited's direct and indirect cost is say 15 per hour, right? Also, let's make two assumptions that the finance charges are USD 2. Finance charges are 2 per month. Right? So what will happen here is, let's try and understand. So now in this case, if you see how we will start the CPM method. Right? Now if I say here the services are provided to XY Limited at rupees 36 per hour. Right? So my hourly rate to unrelated party, or which is my sale price, is 36 per hour. Right? Then my direct and indirect cost remain same, which is 15 per hour. Less cost, 15 per hour. Less finance, sorry. First, I am coming to my cost, which is 36 and 15. Out of 36, which is the selling price, 15 is my cost. Right? Now, what it was said is that AB INC is making the immediate payment, while AB Limited is taking, XY Limited is taking 45 days, which is 1.5 months for making the payment, and finance charges are 2 per month, isn't it? So what I'll do is, here it is not having any finance charges. AB INC does not have to pay any finance charges, but XY Limited has 45 days credit period, right? So my finance charges will be added over here. So what I'll do is add finance charges, which is 1.5 month into 2 per month, which comes to 3, isn't it? So 36 minus 15, which gives me 36 minus 15 and minus 3. Sorry, it should be less. It should be less. So 36 minus 15 minus 3 gives me 18, which is my markup. Right? Now markup on cost will be 18 divided by total cost is how much? This is my total cost, which is also 18. So I have 100% markup on the cost. Right? Now what I'll be doing is, I'll be taking cost of AB Limited, which is cost of AB Limited is 15. This finance charges is not present for the AB INC. So I will not take that into consideration, right? So I will only take 15 over here. I'll only take 15 over here. I'll not add finance charges because for AB INC that 2 per month of finance charge is not applicable. That was only there for XY. Right? I will add 100% markup, which comes to 15. So my ALP comes to 30. My selling price should have been 30 per hour. How much it is at present? It is 25 per hour. So therefore, 5 per hour is the addition. Are we clear? So what we are doing under the costless method is, we are determining direct and indirect cost of production or services, gross profit margin on cost, of comparables is applied. This will give you the ALP and you can make any adjustments if any. Are we clear? Now this cost plus method is suitable for the service provider who are incurring the cost for the production of semi-finished goods where the cost is incurred, right? So in these cases, the cost plus method is suitable. Shall we do a sum on this from your module on the cost plus method? Let's do a small sum on that. ABC Limited Canada holds 35% shares in LMN Limited. LMN Limited develops software and does both on-site and off-site consultancy services for the customers. LMN Limited during the year billed ABC Limited Canada for 120 man-hours at the rate of rupees 1800 per man-hour. Total cost, direct and indirect, for executing this work amounted to rupees 2,25,000. However, LMN Limited billed XYZ Limited India at the rate of rupees 2,800 per man hour for the similar level of manpower and earned a gross profit of 50% on its cost. Transactions of LMN with ABC Limited and XYZ Limited are comparable, subject to the following differences. While LMN Limited derives technology support from the ABC Limited, there is no such support from XYZ Limited. Value of technology support service received from ABC may be put at 18% of normal gross profits. As ABC Limited gives business in large volumes, LMN Limited offered to ABC Limited a quantity discount which may be valued at 10% of normal gross profits. In the case of rendering services to ABC Limited, LMN Limited neither runs any risk nor incurs any marketing cost. On the other hand, in the case of services to XYZ Limited, LMN Limited has to assume all the risk and cost associated with the marketing function, which may be estimated at 12% of the normal gross profits. LMN offered 1 month credit to ABC. Cost of providing such credit may be valued at 2% of gross profits. No such credit was given to XYZ. Compute the ALP with the income to be increased under the cost plus method. So start computing and let me know the answers. Quickly tell me what are your answers. What will be the arm's length price? Very quickly. What is your margin coming up to? What are your margins? Shall we solve together? Yes or no in chat box. Are you finding it easy or difficult, or we should solve together? Vidura, 50% is your margin. No, that is the normal margin of the unrelated party, but you have to make the adjustments, right? Yes, Shayadev, very nice, very good. Correct answer. So what is the arm's length price, Jayadev? Your margin is correct, absolutely. What is your arm's length price coming up to? Okay, Geeta, you're finding it difficult. Okay, we will do it together. Do not worry. We will solve together now. There's no problem in that. Okay, let's solve together. Puneet, the ALP you're saying is 289,500. No. I think you've done some minor mistake because your GP is coming wrong. And that's why your answer is coming wrong. Jayadev, yes, very nice. Correct answer, absolutely. Okay, let's solve it together. Let's see how to approach this question. Now, first and foremost thing, always in the question, you have to write that these are the associated enterprises, because without which the transfer pricing will not be applicable. Since here they have more than 26% holding, ABC Canada is holding more than 26% in LMN, therefore they are associated enterprise. Plus you have to also write that the transaction of developing the software is an international transaction, and therefore TP provision is attractive. Correct? Now what they have said is that LMN has billed XYZ at the rate of 2,800 per man hour for the similar level of manpower and earned a gross profit of 50% on its cost. So here we don't need to find out the gross profit on cost. They have directly given in the question that 50% on the cost is the gross margin of the comparable transaction. So we will directly start with it. In the earlier question, the example I gave you, there we had to find out that what is the gross margin on the cost. Here it is directly given, right, for the comparable transaction. So gross profit margin on cost of comparable is your 50%. Right? Now you need to make the adjustment. First, it is said that the LMN derives the technological support from ABC, and XYZ does not provide that kind of support. And they have said it that the value of technology support is 18% of normal gross profit. So this particular technological support is being provided by the LMN, by the ABC, but that particular support is not given by XYZ. So what we need to do here is we need to reduce from the gross profit this particular technology support value. So less value of technology support, which is 18% of normal gross profit margin. 18% of normal gross profit margin is 50%. So 9%. Right? Because ABC is providing, XYZ is not providing it. So therefore, we need to reduce from the margin of the XYZ. Right? Second is the ABC is giving business in large volumes. So therefore, LMN is offered a quantity discount. LMN is offering the quantity discount, which is 10% of normal gross profit margin, which is not given to XYZ. So what will happen? My gross profit margin will further reduce, because this is I'm giving to ABC, but I'm not giving it to XYZ. So less quantity discount, which is 10% of normal gross profit margin, which is 50%, which comes to 5%. Right? Third adjustment. They have said it that in case of rendering services to ABC, Element does not incur any risk or marketing cost, but it incurs the marketing cost and other risks, and which is amounting to 12% of normal gross profits for the XYZ. So in this case, we are not incurring any cost for the ABC, but we are incurring the marketing cost for XYZ. So therefore, we need to reduce this marketing cost from the gross profit margin of XYZ. And it is 12% of the normal gross profit margin, which is again 50%, and which comes to 6%. Right? Now this comes to 30%. What additionally has been given is Element is offered 1 month credit to ABC and it is not given to XYZ. So this particular credit is given to ABC, but it is not given to XYZ. And therefore the cost of ABC will increase. The cost will increase if it is being provided to ABC. Right? And therefore add credit cost, which is, they have said is 2% of the normal gross profit. So 2% of 50%, which comes to 1%. So 31% is your normal GP margin on cost. Right? Now, what is the cost incurred by ABC? Element for ABC? It is said that Element has billed to ABC for 120 man hours at the rate of 1800 per man hour. So that is what I need to find out, that whether it is at ALP or not. The cost is already given in the question. The cost incurred, direct and indirect cost, is 2,25,000. So cost direct and indirect is 2,25,000. Add GP margin, which is at the rate of 31%, which comes to 69,750. So therefore, my ALP would be 2,94,750. And how much I have billed less actual billing is 1,800 into 120 man hours, which comes to 2,16,000. So therefore, there will be a TP addition of 78,750. Are we clear? Any doubt? Yes, Santosh, you had got right answer, 31%. Priya, yes. Jayadev, yes, correct. Right. So this is how we need to calculate the cost plus method. Are we clear? Shall we do one more small question on this? Now you are going to solve it entirely. I'm not going to solve it. Okay. Again, this is a May 18th question. Amar Private Limited is engaged in IT enabled services. It is subsidiary of ABC Inc. in US. It also provides similar services to a company SAK Limited, Singapore. Its billings and other information is billings to ABC Inc. USD 85,000 per month. Billings to SAK Limited USD 70,000 per month. ABC Inc. has provided loan of USD 1 lakh to Amar Private Limited towards purchase of hardware for executing its project. Rate of interest charged for loan is at 3% per annum. Rate of interest for the loan is 3% per annum. Direct and indirect cost incurred. Direct and indirect costs incurred are USD 100 and USD 200 per hour respectively. Amar Private Limited works 9 hours per day for 15 days to execute projects of ABC Inc. and 8 hours per day for 15 days for SAK Limited. Service was provided by company to both its customers throughout the year. Warranty was provided to SAK Limited for a period of 2 years. Cost of warranty is at the rate of 1% of direct cost incurred. 1% of direct cost incurred. The cost of warranty is not included in direct or indirect cost. 1 USD is equal to rupees 64. So tell me the arm's length price for this using the cost plus method. This should not be very difficult for you. What should be the answer very quickly? What are the answers quickly? Shall we solve together? Let's start solving together. Meantime, you can give me the answers. Right? Okay. Let's start with it. First, we will see about SAK because that is the comparable party, right? And unrelated comparable party. So what is the direct cost? They have said it that the direct cost here is direct and indirect cost incurred 100 and USD 200 per hour respectively. First I'm writing direct cost. Now it is said that Amar Limited is working 8 hours per day for 15 days for SAK Limited. So 8 hours into 15 days into USD 100. So this will give me 12,000 USD. This is all in USD, right? Similarly, for indirect cost, it is 8 hours into 15 days into USD 200, which gives me 24,000. This gives me total cost as 36,000. Isn't it? Now, what is the billing per month? What is the billing per month? Billing to SAK is USD 70,000 per month. So billing is 70,000, right? So my gross margin is basically 34,000 and GP on cost comes to 94.44%, right? So 34,000 divided by 36,000 into 100. Isn't it? So this will give me for the normal gross profit margin on the cost. Now I need to make some functional adjustments to make it comparable, right? Now what they have said it here is, let's do one by one. ABC has provided loan to Amar Limited towards purchase of hardware for executing its project. The rate of interest charged for loan is at the rate of 3% per annum. Now this particular loan amount which is given, right, the interest on loan which is given by ABC is separate. Again, this is a tainted transaction, so I will not make here any adjustment for that because this is a separate, this is not related to any of these gross profit margin, right? This is going to be separate. Next, they have said it, warranty was provided to SAK for a period of 2 years. The cost of warranty is 1% of direct cost incurred. The cost is not included in direct or indirect cost. So what I'll do here is, I will add the cost of warranty because this is provided to SAK for a period of 2 years, which is not included in direct or indirect cost. So my GP margin here will increase, which is going to be 1% of your direct cost, which is 12,000. So this is going to be this is going to be how much? 120. This is going to be cost of warranty is going to be 120, right? And because of which my total cost will get increased because this was not included in my direct or indirect cost. So I will add it to my cost and therefore my total cost here will become, instead of 36,000, it should be 36,120. And my gross margin, instead of 34,000, this will be 880. And my GP margin will be 33,880 divided by 36,120, which gives me 93.80%. So this is my normal gross profit margin. I have to also add it here, the cost of warranty, because this was not included, right? Now what I'll do is, I'll calculate the arm's length price. So again, direct cost for ABC will be 100 USD into how many hours it has been working? It has been working for 9 hours into 15 days. So 9 hours into 15 days, which comes to 13,500. Indirect cost is going to be 200 into 9 hours into 15 days. This is going to be 27,000. So my total cost will be 40,500. Right? My total cost will be 40,500. Now on this cost, I will also add this thing. ABC has provided loan and the rate of interest is 3% per annum. So I need to add here to the cost the interest on loan. It is assumed that this is at ALP because here no other information is given. Right? It is assumed that this is also at ALP because no other information is given. So on loan of rupees 1 lakh into 3% per annum, we are calculating here for 1 month. All these are monthly figures, right? So divided by 12. It comes to 250. So 40,750 is my cost. Here I am applying the profit margin at the rate of 93.80%. Right? It comes to 38,244. 38,244. Right? Right? 38,244 is the margin and my arm's length price should be 78,974. And what we have exactly charged them? 85,000. So since we have charged already higher, there is no need of any transfer pricing adjustment. Are we clear? Any doubt? Any doubt? So this is how you will calculate the cost plus method. Clear? Yes or no? Okay, let's take a small break of 10 minutes and then we get back. 10 minutes break. Let's start. Let's start, students. Am I audible? Okay. Namita, your question is in Microsoft question. We also reduced it. We assumed that it is at ALP. We reduced it in Microsoft question also. We did that, right? If you see this Microsoft question, this one, right? Here we had reduced it. I told you less installation charges, right? So we have done that here also. And here similarly we have added because here it is cost. Interest on loan I have calculated here, it is 3% per annum divided by 12 months, right? Yes, Naveen. So the adjustments that will affect the cost will be considered. You are correct. Okay, let's proceed further. So these were the traditional methods. Why these are traditional methods? Because here we are focusing only on the direct comparison. Direct comparison of the margins, of the gross profit, or the pricing under the cup method. Now we are moving towards the transactional method where we are looking into the entire profitability of the company. So we have two methods under that. The first one we are going to talk about is transactional net margin method. As the name suggests, this is taking into consideration not the gross profit margin, but the net margin. This takes into consideration the net margin. Now, you will be asking the question that, ma'am, net margin on sales or net margin on purchases? It depends on the kind of the entity, the nature of the transaction to be examined. On that basis, you will decide whether it will be on the net margin on sales or net margin on purchases. It could be net margin on assets also, depending on the transaction and the level of and the nature of the entity. Why that is so? Because this is a residuary method. When none of the above methods are applicable, CUP, RPM or CPM, we go to TNMM. So it is quite possible that for a reseller, the RPM method is not we are not able to apply. Why? Because it could happen sometimes that we did not have the availability of the gross margin of the comparable company. It is very difficult to find out the gross margins. Because even in the reports which you find, the financial statements, the annual reports you find, you will mostly find the information, detailed information about the net margin. It is sometimes not possible. Even if it is easily identifiable, it might not be possible to make the adjustments. So therefore, even for a reseller, we may resort to transactional net margin method. Similarly, for a service provider, again, we may not be able to find out the cost or the adjustments for that with respect to the gross profit on cost. So we may resort to the net margin method, and there we will take into consideration net margin upon the cost for a service provider. For a reseller, we may take net margin upon sales, right? So it depends upon what is the level, what is the nature of the entity, what is the transaction, and based on that, the net margin will be taken into consideration. Depending on the denominator will depend based on that. It could be cost, it could be sales, it could be assets employed. So the base will change according to the nature of the entity, right? So how we will calculate? Again, it's going to be the same method as RPM or CPM, but the only difference here is going to be here we have net margin rather than the gross margin. Clear? So under the transactional net margin method, we are taking into consideration the net margin rather than the gross margin. Let me just give you an example for this. A small example to understand this. Say for example, there is AB Limited it is purchasing antivirus software from ABINC US, its parent company, at the rate say rupees 650 per pack. Now AB Limited incurs expense of rupees 200 for labeling. And sells for rupees 1000 per pack. Right? It also purchases similar antivirus software from say Windows at say rupees 3000 per pack. And it sells for say rupees 5000 per pack. Plus it incurs some additional charges of rupees 400 per pack. Right? So here also you will say that your RPM method should be applicable. But say for example, if the data is not available about the gross margins of the comparable company, or we are not able to make the adjustment. So what we'll do is we will adopt the TNMM method. So under TNMM, same thing, we will take the sale price of Windows, which is 5K, less purchase price 3K, less expense of 400. This gives me net margin of 1600. Right? Your net margin will be taken on sales because this is the tainted transaction. So I need to come from cost to the sales. So I will take net margin upon sales, which will give me 32% as the net margin ratio. Right? So again, I will take into consideration the sale price to the customers, which is 1000, less net margin, which is 320, 32% on 1000. And this will give me the cost, which is going to be 680 rupees. From this, I will reduce the expense, which is 480 rupees. Which is not 480, it is 250, sorry. It is 250 rupees, right? From this, we will reduce, let's make it 200. Not 250, let's make it 200. So I will reduce this 200, this will give me 480, right? And this will be my ALP. I have sold it for, I have purchased it for 650, ALP is 480, therefore there will be addition of 170. So it is same like your RPM and CPM. Similarly for a cost provider, we will add all the costs, we will apply the comparable margin on those costs, and we will come to the sale price. So it is going to be the same method, but here the difference is just that here it is net margin instead of gross margin. Clear? Is that clear? Any doubt? Namita, as I said in the Microsoft question also, in this question you are asking, right? Here also we have reduced it. Here we had the figure available. We did not have the percentage available, right? So here also we have reduced it from the ALP, the installation and the support charges. Similarly, I told you here in this question, Amar Private Limited, here we are adding to the cost. So it's the same thing. This is the cost of warranty. This was with respect to SAK only. So therefore we have added to GP, to the total cost, and based on that GP is calculated. We have not added anything to GP. We have added to the cost only. Do not get confused. Is that clear? Okay. So shall we solve one question from your module based on TNMM? Let's solve one question for TNMM from your module. You need to give me the answer. And this INC, having its business in Malaysia, has advanced a loan of MD 1,60,000 to Endis Limited. Book value of total assets of Endis Limited was rupees 125 lakhs. Endis has provided software backup support to Endis INC. Endis Limited had spent 50,000 man hours during the financial year for the services rendered to Endis INC. Cost for Endis Limited is MD 75 per man hour. Endis Limited has billed Endis INC at MD 90.75 per man hour. Gamma Limited in India, which has a similar business model, provides software backup support to Olive INC in Penang, Malaysia. Gamma Limited's cost and operating profits are hereunder. Direct cost, indirect cost, operating profit. Calculate the arm's length price. Assume 1 MD is equal to rupees 45. So, tell me the answer. You have to calculate using TNMM. Namita, so in the earlier question also we reduced it after GP ratio is calculated. Here we are looking at cost. So we are adding it first and then taking into consideration the GP ratio, right? There we were looking into the sales. So we reduced it. There also if you see, I have taken after considering GP ratio. Here also I am adding it because here these are the cost and I am calculating GP on the cost. I cannot add the cost to the GP. I have to add the cost first and then calculate GP. There it was the cost which was to be reduced from the gross profit to come at the ALP price, right? So that is the difference. This is a very simple question. Please be very quick. Yes, Naveen, very good, very nice. Namita, in the Amar Limited question, we are calculating GP on the cost. So we are adding all the cost, including that interest expense, so that we arrive at the sales figure. In the Microsoft question, you were arriving at from the sales figure towards the cost. So you reduced it after reducing GP. You cannot reduce sales minus cost and then reduce GP. You cannot do that, right? You first need to arrive from the sales towards the GP and then you reduce the cost and the balance would be your ALP. Got it, Namita? No, Geeta, that's not the correct answer. Yes, Priya. Right. Okay, let's discuss it together. Very simple question. But first of all, you need to write in this question that Endis INC has advanced a loan of 1,60,000 Malaysian dollar, right? And the book value of the Endis Limited was 125 lakhs. So 1,60,000 is in Malaysian dollar. You need to convert it into the Indian rupees to see if they are associated enterprises or not. So 1,60,000 into 45 divided by 125 lakh, which is the book value of asset. So here, if the loan advance is greater than equal to 51% of the book value of total assets of Endis Limited, then both of them are deemed to be A. And here it constitutes 57%. So both of them are deemed to be associated enterprises. You don't need to divide 160 by 125 lakhs. You need to convert it because that is in Malaysian dollar. Then you need to write that this particular software development service or software backup support service is an international transaction and therefore TP will be applicable. Right? Here you directly have the operating profits given, which is 200 of the this company Gamma Limited, right? So 200 is your operating profit. 200 divided by here, what will be the base? It will be cost because the sale price is the tainted transaction. So we need to come from the cost to the sale price. So we will take 200 divided by cost, right? We will take the net margin upon net margin, the base will be cost. So 200 divided by 800, which is your cost, will give you 25%. 800 is your total cost. So 25% is your normal net margin. Correct? Now what you will be doing is the cost for the Endis Limited is 75 per man hour. And how many man hours it has worked? It has spent 50,000 man hours. So 75 into 50,000 into rupees 45, that will give you the cost of Endis Limited. On that, you will apply 25% and you will arrive at your sales figure. You will arrive at your sales figure, right? So 25% of that you will arrive at your sales figure, and less the amount billed will be your difference, will be your transfer pricing adjustment. So I'll take you to the answer. You will see here they have cost of 75 into 45, right? 75 Malaysian dollar into 45. That is your cost. You will add 25% to that and you will come at arm's length price. 4218 is the arm's length price into 50,000 man hours. That comes to 21 crore 9 lakh 37,500. And you have billed 90.75 Malaysian dollars into 45 rupees into 50,000 man hours, which is less. So 67 lakh 50,000 is the transfer pricing adjustment. Is that clear? Any doubts? Yes, Jayadev. Geeta, I think you had done some mistake. Priya, yes. Okay. Let's proceed further then towards the next method. Last method under transfer pricing, which is profit split method. Now let's understand first the logic about it. What is profit split method? Now what happens? See, it is not always possible that we find out the comparables. I told you very first day also that the biggest drawback of ALP method is that we are not always able to find the comparable, especially in case where there is heavy brand value attached. There are many intangibles, patents, copyright, goodwill with a company, so that we are not able to find their exact comparables. Even if we find comparable, the adjustments are not possible. There are sometimes so complex and integrated operations between the company that you are not able to find their true exact comparable. So in that case, we may adopt to the profit split method. Now, what does it do? Let's take an example. Suppose Infosys purchases a software to be used by all of its companies globally in US, Singapore, Australia, Japan. This is an ERP which will be used by all the companies globally. Now this software costed say rupees 50,000. Some hypothetical example, right? And since all of these companies are going to use this software, what Infosys will do is it will allocate this 50,000 amongst these companies in some ratio, because why Infosys India only should bear the cost when it is to be used by all the companies globally? So what it will do is it will charge the cost to all these companies. Right? It will charge the cost to all these companies. Say in the ratio of 10% to US, 20% to Singapore, 30% to Australia, and 40% to Japan. Based on, say, the employees employed by this company. This is the ratio which has been determined. So what is happening here is this particular cost is being allocated to these different companies. And now we need to see whether this allocation key is at arm's length or not. So for that, we will use profit split method. It basically split your contribution or the profits. Another example could be, say for example, Infosys has incurred certain cost on R&D. Now R&D will benefit to all the companies globally. and therefore that cost will be allocated. And therefore we need to see whether the cost allocated is correct or not. So what happens under profit split method? There are two types of, or there are two approaches basically under the profit split method. The approach one is that you need to determine combined net profit of the A. You need to determine the combined net profit of the A. Right? You will find out what is the combined net profit of the A. Then what you will do is you will compare the relative contribution earned by each enterprise for earning the combined net profit with respect to the functions, assets, and risk of those enterprise. So what you are basically doing here is you will determine the combined net profit. Here I have used the term net profit. It could mean also the cost. Here, because we have incurred the cost, here it is not net profit, here it is a cost. It could be net profit also based on, say for example, there are integrated operations where each entity is contributing towards the net profit of Infosys. So then in that case, we will take net profit. But here, since Infosys has incurred the cost and it has allocated to different entities, so here we will take the combined cost, which is 50,000. What we will do, we will compare 50,000. Say for example, we are comparing for US, which is 5,000, 10%, right? We will compare the relative contribution of each entity, US, Singapore, Japan. We will identify whether this 10% is correct or not. How we will identify? Based on that, how this 10% is determined. We are saying it is determined based on number of employees. We will see, okay, whether the employees are really performing these kind of services so that the 10% software is allocated to this company. Or is it just sham 10%? It is quite possible that since tax rate in Singapore is lower, they have allocated their 20%. But in actual, there are no employees in Singapore. So we will see what each entity is performing the functions, what assets each entity has, what risk each entity is undertaking. Based on that, we will allocate the percentage and we will compare it with the contribution earned by unrelated enterprise in similar circumstance. So if we are able to find out the comparable also doing similar transaction, we will compare these particular percentages with that of the comparable parties, unrelated parties. And then we will split the net profit or cost in proportion to the ALP percentages to arrive at arm's length price. So if say for example it is observed that this 20% is not a correct percentage based on the comparables, based on the function classification, that Singapore entity does not have any employees, and we feel that only 5% is there. Only 5% should have been allocated. So this 10,000, instead of allocating 10,000, here it should have been only 2,500. So 7,500 will be added back. Are we clear? This is the fun approach. The second approach under the profit split method is that first you need to allocate the profit or the normal profit to each enterprise. First, you need to allocate the normal or the routine profit to each enterprise. Say, for example, instead of your cost, it would have been profit. So what I'll do first is, I will allocate the normal margin. What is the normal margin without the contribution of each entity? Say it is 10%. I will allocate that 10% to all the entities. And then, say for example, Infosys has earned 50% margin, out of which ideally the companies like Infosys, the software companies, ideally the comparable companies earn 10%. So first I'll allocate this normal 10% because this is the normal margin. Normally the software companies in the industry are earning 10%. Exceptionally 50% is earned by Infosys because of the contribution of all the entities to the Infosys. So what we'll do, we'll first allocate the normal return to all the entities, and then we will allocate the residual return, which is 40%, based on their relative contribution. And ALP will be 1 plus 2. Normal return plus the residual return. Is that clear? So this is the profit split method, the last method which we have talked about. Clear? Any doubt? Are we clear? Namita, in that question of Microsoft, we were first computing, let me take you there. So this is the question, we were computing the selling price. After that, we reduced the gross profit percentage to arrive at ALP, and from that particular amount, we are reducing the installation charges. Because we cannot reduce installation charges from selling price. From selling price, we will first come to the cost, and from this cost, we will reduce the installation charges to come at the purchase price, which is my ALP. Because here we are calculating RPM method, which is sale minus gross profit margin, which will give me the total cost. Whereas in this Amar Limited example, what we are doing is we are following cost plus method. So we are first adding all the cost, and on the cost we have to calculate the gross profit margin. So on the cost we will have the margin and in that case it was on the sales we reduced the margin to come at cost, and from that we reduced it. Are you getting? So there the total cost was there, and from total cost I reduced installation charges to come at my purchase price. Here I am adding first all the cost to arrive at the total cost, and then add the GP on it to come at the selling price. Right? Is that clear? Namita, I just now explained it. Okay. Let's proceed further then. So this is about the methods of calculating ALP. Now, as I told you, when you are calculating the methods, how do you decide which is the most appropriate method? As I told you, Rule 10B gives you the criteria for that. You need to take into consideration the specific characteristic of the transaction, the function performed, the assets employed, risk undertaken by the parties, the contractual terms of the transaction, all that you need to take into consideration for the purpose of judging the most appropriate method. Isn't it? So you need to understand, we have done that what is the nature and class of international transaction, what are the nature of the AEs which are entering into transaction, what is their function, what are their assets, what are their risks, if the data is available or not. So if the data is available, I can use CUP also, I can use RPM also. If data is not available, I will have to go to TNMM. If the comparability, even if the data is available, whether the adjustments can be made or not, because the least adjustments you will make, the more appropriate answer you will arrive at, right? So whether you can make the comparability or not, whether you can make the reliable and accurate adjustments or not. So based on that, you will come to the conclusion that this is the most appropriate method, right? So that particular criteria is given under the rule only. Now understand one thing. Understand one thing. So when you are comparing, you don't need to come to the exact comparison, but the comparison, the adjustment should be made so that the differences between the comparable transactions, the controlled and uncontrolled transaction, are less and less, so that even if there are minor differences which are not affecting the price majorly or the cost majorly, that is all right. But the differences should not be so major between them that the price or the cost will get altered because of that difference. So therefore, we need to make the accurate adjustments to eliminate those material differences. Clear? Now understand one thing. Here, if say for example, the data is not available for the current year. So there is a concept called as multiple year data. Multiple year data, which I will talk about in a while. But for the time being, understand, if at the time of deciding the ALP, if current year data of comparables is not available, so quite possible that when I am making the transfer pricing adjustment, or when I am deciding the comparability, when I am trying to analyze my transfer pricing ALP, then in that case, it is quite possible that the current year data of the comparable company is not available, because quite possible that their audits are also not finalized. Their financial reports are not yet available. So in that case, the Act says that if your method is RPM, CPM, or TNMM, then you can also use the past year data. So the financial year preceding the current year data you can use. So if you should ideally be using the current year data only. But if say for example, the current year data, the data of the year in which international transaction has been entered into, that year data is not available for some reason, then you can use the data relating to the last year also, if the current year data is not available at the time of furnishing the return of income. Is that clear? So you can use financial year preceding the current year data can be used if current year data not available till ROI is furnished. So ideally you should be using current year data, but if it is not available and if the method is RPM, CPM, or TNMM, you can use the past year data. However, say for example, now the assessing officer is assessing your case. Now the assessment is being made. And at that point in time, the assessing officer has all the financial statements of the comparable companies because their audits would have been finalized by then. Then whether the assessing officer will reject that current year data? Answer is no. So where the data relating to the current year is subsequently available at the time of assessment, then the assessing officer will use the current year data irrespective of the fact that it was not available when you made your transfer pricing analysis. So AO or TPO, transfer pricing officer, can use current year data if available subsequently irrespective of the fact that it was not available at the time of furnishing ROI. Is that clear? Is that clear? Clear? Okay. Any doubts you have? Great, Namita. Okay. Now understand one thing. It is quite possible that in case of these international transactions, also remember these methods will not only apply to international transactions, but these methods are equally applicable for specified domestic transaction. We have done specified domestic transaction in last class on inter-unit transfers, on the company opting for 115BA, 115BAB, right? So there also these methods will be applicable to determine ALP. Now it is quite possible that the prices which are determined, the ALP, can be more than one. In real life, we will not have only one comparable. We will have many comparable. There are hundreds of companies which are operating in the similar field. So I will have more than one comparable company in real life. Here, these are just exam problems where you have just one company which you are comparing with your gross margins, net margins, prices. But in real life, there will be thousands of companies which will be comparable to you. You know actually how it happens practically. Practically, I'll tell you. There are these softwares. The major softwares which are used. I'm telling you very practically. Prowess and Capitaline. These are the names of the software which are used for transfer pricing. Why do we use this software? We use these software basically to find out the comparable companies. Now you will ask, ma'am, what does this software do? So this Prowess and Capitaline software have accumulated database of the annual reports, of the annual financial statements of all the companies available in the public domain. And what they have done is, in the software, they have applied various filters on that. That when you go to the software like Capitaline, you will put your company type as software company. So when you put software company, the whole list of database of the software company will appear. Whole list will appear. Then what you will have to do is, you will have to then filter it. Okay. This kind of company is not comparable to my company because it has like huge turnover. I am just a beginner. I am a startup. So I cannot compare myself to this company. Say for example, a startup software developer will not compare itself to Infosys. Maruti Suzuki will not compare itself to Mercedes-Benz, right? So you will filter it out. So these software just help you identifying the comparable. But as I said, the point is there are so many comparables available in the market. So when there is more than one comparable, how do we get at ALP? There will be multiple ALP. One comparable will give you ALP of 1000 rupees. Another company will give you ALP of 2000 rupees. Third company will give you of say 7000 rupees. So what is the correct ALP? So for that, there are two methods. One is range concept and second one is arithmetic mean. Let's try and understand what is range concept and what is arithmetic mean. Now, it so happens that in the range concept, what happens is we have a particular range of the ALP. And if your ALP falls, if your transfer price basically falls within that range of ALP, you are at arm's length price. So there will not be one single ALP which will be arrived at, but here you will be having a range, a starting point and an ending point. Say for example, starting point is 1000, ending point is say 5000. So if your transfer price, if your selling price or purchase price is say 3000, you are at ALP. So if you fall within that band of 1000, 3000, you are at ALP. Or 1000, 5000, you are at ALP. Now let's try and understand how or when this range concept works. So if there is more than one ALP, then in that case, and if your method is cup, RPM, CPM and TNMM, then in that case your PSM is not included. For the PSM, the range concept is not there. So when your method is resale price, cost plus, or transactional net price method, or the cup method, right? In that case, you can go as per the range concept. And if you have the PSM method, you will go as per the arithmetic mean. Further, the second condition for the range concept is comparable should be greater than 6, greater than equal to 6. So there should be more than or equal to 6 comparable companies. I should be having at least 6 comparable companies. If it is less than 6, I can go for arithmetic mean. If there are only less than 6 comparable, I can directly adopt the arithmetic mean. Right? So now what happens? Let's try and understand first the range concept before we go to the arithmetic mean. Arithmetic mean, you all know. Say for example, we have 6 companies. We have found out 6 ALP. You will take the mean of that. That is your arithmetic mean. Now let's try and discuss first about the range concept. How do we calculate the range? So understand this thing. Say for example, there is an Indian company, say AB Limited. It is subsidiary of say AB Inc. US. Right? Now AB Limited has sold raw material of 7,000 units to AB Inc. at the rate rupees 9,200 per unit. 9,200 per unit. right? It has sold similar raw material to unrelated parties. Now, if it has sold the similar raw material to unrelated party, means we have the internal comparable, right? These are called as internal comparable. External comparable means some XY Limited would have sold to some YZ Limited. That is external comparable, right? So, these are the details of the comparable companies. Comparable companies. Say for example, X Limited, P Limited, Q Limited, R Limited, S Limited, T Limited, right? Y Limited, Z Limited. Now, your prices are, these are your prices, say rupees 8,990 prices per unit, right? Rupees 9,400, rupees 8,400, rupees 11,000. Say we do not have any transaction with S Limited during the year. Rupees 10,000, rupees 10,990, rupees 9,900. Say we have E Limited, one more company will take rupees 10,330, right? Now, first of all, both of these are associated enterprises because parent subsidiary. This is an international transaction, right? Now, what we'll do is, we will write, since there is more than one ALP and comparable companies greater than 6, we would apply range concept. Now, what happens in the range concept? The first thing is arrange the data set in ascending order. Arrange the data set in the ascending order. First thing. So what we'll do is we'll arrange this in the ascending order. First is, the smallest one is 8,400, which is Q Limited. Next company is 8,990 X Limited. Next company is 9,400 P Limited. Next is 9,900 Z. Next we have 10,000, right? T Limited. Next we have 10,330. Next 10,990. And finally we have 11,000. Finally we have 11,000, right? Of R limit. So this is arranged, right? Now the second step is, this is the step 1. Arrange the data set in ascending order. Second step, determine 35th and 65th percentile. Determine the 35th and 65th percentile. Now, what is your 35th percentile? Is equal to total number of comparables into 35%. That will give you the 35th percentile. Total number of comparables are how much? 1, 2, 3, 4, 5, 6, 7, 8, right? So 8 into 35% will give you 2.8, right? 2.8. Now, if your amount, if this particular figure, 35th percentile which is there, or 65th percentile is there, right, is not a whole number, then round it off to the next number. Since not whole number, rounded off to next number, which will be 3, right? Now the value at your third place in the ascending order, this is your first range. So value at third place will be your first range. So if this is not a whole number, then round off to the next number. And if it was whole number, say it would have been 2 instead of 2.8. Then if it is whole number, then what you need to do is you need to take the average of percentile and next higher value. So had it been a whole number, what you would have done is you would have taken the average of the percentile and the next higher value. Is that clear? Is that clear? So if it is whole number, you will take the average of the percentile and the next higher value. So 2 plus 3 divided by 2. You will take the average. Right? And if it is not a whole number, then you will round it off to the next number. Are we clear? Are we clear? Clear? Okay. So value at third place is 9,400. Now we move towards the 65th percentile. Now what is 65th percentile? Again, total number of comparables into 65%, which is 8 into 65% is equal to 5.2. Is it a whole number? No, it is not a whole number. So you will take it to the next number, rounded off to 6. Now at the 6th place, you have this particular amount, 10,330. So you will take the next amount is 10,330. So your range is between this particular amount, 9,400 and 10,330. Now what is my transfer price? What is my transfer price? I have transferred the goods. I have sold the goods for 9,200. Now, whether this falls within the range, what is my range? My range is 9,400 till 10,330. My transfer price was rupees 9,200. So whether I am in the range, the answer is no. So I am not in range. So does that mean that what will be the TP addition? How will you do? Will you add 9,400 minus 9,200, or will you add 10,330 minus 9,200? What will be the TP addition? I am saying I am not in range. Now next what? So for that, what you will be doing is, if it is not in range, you will take the median. What is median? Median is 50th percentile. If I would have been in the range, then I am at arm's length. If the transfer price say would have been 10,000, then I will not make any addition. But now if I am not in range, there will be median taken. Now what is median? Median is the 50th percentile, which means again 8, which is total number of comparables, into 50%, which comes to 4. Now since 4 is a whole number, this is a whole number. What did I say? Average of that particular percentile and the next number. So average of 4th and 5th place will be taken. Now what is the 4th and 5th place? This. So average of these two things will be taken up. Average of 4th and 5th place will be taken. If it would have been 4.2, we would have rounded off to 5. So average of 4th and 5th place, which is 9,900 plus 10,000 divided by 2, which comes to 9950 per unit. And this will be your ANP. So what you will make adjustment is, so your adjustment will be 9950 minus 9,200 into 7,000 units. This will be your TP adjustment. So did you understand how do we calculate the range concept? Namita, quite possibly you can reject it if it is not aligning with your current year data. Are we clear? So this is about the range concept. So what you will do, first step, arrange in the ascending order, obtain the 35th percentile. What is 35th percentile? Total number of comparables into 35%. Okay. That will give you, if it is a decimal, round it off to next number. If it is a whole number, take the average of the numbers, the data at that particular place and the next place. Then obtain the 65th percentile in the similar way. Total number of comparables into 65%. Whatever the figure will come, if it is a whole number, take the average of the numbers at that place and the next place. If it is a decimal, round it off to next place and take the data at that particular place. That will be your range. If your transfer price is within the range, it is at arm's length. If it is not within the range, take the median. What is median? Total number of comparables into 50%. Again, if it is a whole number, average of that particular data plus the next data. If it is decimal, round it off and take the data at that particular number. That will be your ALP. So the median will be your ALP. If the transfer price is not within the range. Are we clear? Now, it is also possible, again, under the range concept also, it is possible to have the multiple years data. The comparables data can be of multiple years. So, it is quite possible that the Act allows the data of the earlier years also. So, multiple year data under the range concept can be taken only if the method is RPM, CPM or TNMM. Just like when the assessee also does not have the data of comparable, what he can do? He can take the data of the last year and the method should be RPM, CPM or TNMM. Even for the range concept, we can take the multiple year data of the comparables, but the method should be RPM, CPM, TNMM. For the cup method, we cannot take the multiple year data. So if here it is cup method, right? Here we have followed the cup method because here we are comparing the pricing. If it would not have been, say, the cup method, if it would have been RPM or CPM, we could also have taken the data of, say, 2020, 21 also. For these comparables, we could have taken that. So what is multiple year data? The multiple year data you can take not just of the past year data, but even of the two previous year to the current year. If you not have, so generally if you do not have the current year data, what you do, you take the past year data. But for the range concept, you can take total 3 years data, the current year plus 2 past years. So when the method is RPM, CPM or TNMM, then you can take the current year data, as well as for the range concept, you can take the 2 financial years preceding the current year data. So for the range concept, we can take current year plus 2 preceding financial year data. Right? This is different from what we have dealt earlier. The earlier one was that if you do not have the data altogether in current year, you can take the past year data. There it was just 1 year. But if the AO has the data available subsequently, then he will use that data. Here, for the purpose of applying the range concept, you can use the total 3 years data. And what you will do is, then you will do a weighted average of those 3 years data. So, how the weighted average will be done? Then the weighted average will be done of 3 years data. So instead of here, I am using just 1 year data because it was any which ways the cup method. But if it would have been RPM, I could have taken 2020, 21, 2019, 20. I could have taken 3 years data. And what I would have done is I would have done the weighted average of these 3 data. This is cup, but if it would not have been cup, I would have done weighted average of these 3 data to come at a final data. So for RPM, the weighted average will be based on sales. Weighted average is based on sales. For CPM, it is on cost. And for finally TNMM, the weighted average can be on the basis of sales, cost, assets, the way we have the base, right? Is that clear? So, range concept can be applied only when you have the method other than PSM. And you can take the multiple year data in that if you have the method RPM, CPM, TNM, not for cup. If you have comparable companies less than 6, you will have to go for arithmetic mean. As I said, you will have to go then for the arithmetic mean. So only if range concept will apply only if the comparable companies are more than 6. If it is less than 6 or the method is PSM, then it will be arithmetic mean. So now how do you calculate arithmetic mean? Let me give you a small example. So arithmetic mean, say for example, ABINC US company holds 30% stake in AB Limited. AB Limited sold 500 units of raw material at the rate rupees 9,700 per unit to ABINC, right? AB Limited has sold similar raw material to unrelated enterprise, details of which are given hereunder, right? So, say for example, these are the comparables. Say for example, Y Limited, Z Limited, P Limited, and Q Limited. And we have price for raw material. Say for example, 10,000. These are per unit price again. 10,990, rupees 9,900, and rupees 10,330. Now here, since the comparable companies less than 6, so we will use arithmetic mean. So we will use arithmetic mean, right? And how will you use arithmetic mean? Simple. 10,000 plus 10,990 plus 9,900 plus 10,330 divided by 4, which comes to 10,305 per unit. This is your ALP. Now, what is your transfer price? You have sold for 9,700, right? So, should we make here the adjustment? Should we here make the adjustment of 10,305 minus 9,700? For that, we have one condition. So what the Income Tax Act has said it. Income Tax Act has said that the transfer price shall be accepted if. So for arithmetic mean also they have given some range. And what is that range? They have said that transfer price addition will not be made and transfer pricing shall be accepted if there is variation of 3% of transfer price. So if the variation, what is variation? The ALP minus transfer pricing is less than 3% of transfer price, then transfer price will be accepted. This 3% is 1% in case of wholesaler. For wholesaler, they have given 1%. So in this case, if you see, 10,305 minus 9,700 is 605, right? And 3% of 9,700, which is your transfer price, is 291. So whether 605 is less than 291, the answer is no. So there is more variation. It is not just 3% of transfer price. So if the variation between transfer price and ALP is 3% of transfer price is less than that, then the transfer price will be considered as ALP because it's not a major difference. It is, see, ALP is subjective exercise. What comparables I may find AO may rejected. AO may also reject my method because I may find RPM as the most appropriate method. AO may say TNMM is the most appropriate method. And therefore, ALP is a very subjective exercise. But if the difference is very minor, there is no point of making any addition. But if the difference is more than 3% of transfer price, they will make the addition. So 605 will be made as an addition. Are we clear? Is this very crystal clear? Yes, Namita, 2.2 will be rounded off to 3. Namita, that is a concept which is developed internationally, 35% and 65%. Are we clear? So for arithmetic mean, they have given a range of 1% for wholesaler and 3% for others. Clear? Perfect. Great, Naveen. So what we'll do is, we will stop here for today. We have completed the methods of transfer pricing. We have completed the range concept. We have completed the multiple year data concept. Now in the next class, it will be the TP procedures which we are going to talk about. The safe harbor, advanced pricing agreements. We are going to talk about the secondary adjustment, thin capitalization, all of that, and the TP documentation, TP assessment, all of that we are going to talk about in the next class. Is that clear? So let's meet up in the next class. See you then. If you do not have any doubts, we can just close the session. Okay. Thank you so much.